Most traders are losing money because they're constantly chasing price and blowing accounts. But what if I told you there's just one simple tweak that you could implement right now that has me making over $1,000 every single week? If you understand how supply and demand works, you'll stop trading like a retail trader and start trading with the big boys to make those big profits. By the end of this video, you'll know how to trade smarter, not harder. So here's the tweak most traders completely overlook, and it's probably why you're losing trades. Just wait. Seriously, wait for price to come back to key support or demand before entering. Most traders lose simply because they chase price. They buy too high and they sell too low. It almost seems too easy, but all they're missing is patience. And once you start becoming a patient trader and waiting for pullbacks in key areas, your trades will instantly become more precise and more profitable. There is no complicated trick for this. Just look for supply and demand zones. You know, the ones that are created when institutions are looking to place huge orders that cause big price moves. These areas are often revisited because the big players didn't get to fill their bag all the way the first time. And that's where we come in. When price pulls back, we get an opportunity to enter at the same level as the big players. Instead of chasing, you're now trading with a plan. How can we better draw out these key areas and know when they're there? Of course, there's many ways to do this. I'm just going to stick to a straightforward method that works. We'll call it the pivot zone. A pivot zone is where price sharply reverses, often formed by 1 to 3 candle setups. When marking a supply zone, look for a bullish candle right before a strong bearish move. For demand, look for that same bearish candle before a sharp upward rally. You can choose to mark just a single candle, or you can even include a few. This really just depends on how you want to do it and how precise you want to be. The key though is to capture the origin of the impulsive moves. Let's take a look at an example here of how we could use this to make profits. Look at this chart. We can immediately spot equal highs right here, which highlights a classic liquidity zone. Price runs right through those highs, creating a sharp move with a clean bearish engulfing candle. Those 3 bullish candlesticks become our supply zone. Soon after, price retraces back. This is our entry opportunity. How you trade this is up to you, but you could in theory just set a stop loss above your high and look to target the next low. Real quick, let's look at the reverse scenario. On our chart, we see that price is actually trending down, and then after a while, we get a sudden strong upward move that breaks the structure. But notice what happened just before. Here we have a clean sweep of the recent low. That's our signal that liquidity is being taken. With all these factors in mind, we know that this demand zone is high probability. Once it respects it and starts pushing back up, we know institutions are likely defending it. We can enter here in this demand zone and we'll set our stop below. And as always, aim for a favorable risk to reward ratio. If you found this video helpful, I ask that you share it with another trader that will get value out of it too. Subscribe if you'd like to see more, and make sure to hit that like button. Thanks for watching.